Hey everyone, my name's Glen James. I'm a retired financial advisor and I'm the host of the My Millennial Money podcast. On this video, we're going to talk about the differences between two popular ETFs in Australia, Vanguard Diversified High Growth Fund and the Diversified All Growth Fund from BetaShares. So let's get right into it. Now, I want you to pause your video and I want you to read this disclaimer before we move on. Awesome. So what will I cover? We'll talk about the two fund managers. I'll talk about the objectives of each fund. We'll talk about the time horizons to invest in growth assets and particularly these funds. We'll look at the underlying assets, and this is where we'll really look at the differences between the two funds. We'll look at their fees, the returns, and where they sit in the world, and I'll give you some of my final comments. Now, the fund managers. Vanguard and BetaShares. Vanguard is an international fund manager who have been around since 1975. So they know one or two things about managing money. BetaShares, it's an Australian fund. They launched in 2009 and their first ETF was on the ASX in 2010. So we've got two different fund managers here. We've got a new Aussie fund manager who are doing great things, and we've got Vanguard, big international fund manager. BetaShares, they've got about $22 billion of funds under management, where Vanguard internationally have about $7 trillion. The Australian business of Vanguard have about $140 billion worth of funds. So the Australian business, which was launched in 1996, yes, it is smaller than the total Vanguard pool, but obviously it's been around a lot longer. It's a household name for many investors, so it's expected to have more funds. Just because there's one fund manager that might be, over 40 years old and, have $7 trillion worth of funds under management, doesn't always mean that it's better than any other funds. It's the fact of life that every company had to start at some point. BetaShares just happened to start in 2009, 2010 in Australia. So I think what my plan is for this video is just to show you under the hood of both of the two funds. Now, let's have a look at the portfolio objectives. So I think it's always important to look at portfolio objectives before we invest. DHHF, which is the BetaShares fund, aims to provide a low-cost exposure to a diversified portfolio with high growth potential that may suit investors with a very high tolerance for risk. Where Vanguard say that their ETF seeks to track the weighted average return of the various indices of the underlying funds in which it invests in proportion to the strategic asset allocation before taking into account fees, expenses, and taxes. So what does all that mean? That just means that both portfolios have an objective to high growth and that they want to basically track an index. Now, these funds, they're both index funds. So they track indexes, and we're going to get right into that. So let's have a look at the key facts. The ticker, which is the code that you'll search on the ASX, VDHG, DHHF, you can see the inception date of both of these funds. The difference with the Vanguard one, while the ETF started in 2017, the underlying fund, which was a managed fund, is almost 20 years old. So it's got a long history in Australia, that fund. The fees you can see there, BetaShares Diversified All Growth ETF at 0.19 and Vanguard at 0.27%. They both punch out distributions quarterly. Now, just on the distribution thing, when you've got a packaged portfolio, there's like hundreds and hundreds of underlying shares. Now, each of those underlying shares, they may pay a dividend twice a year. So at all times, maybe there could be income coming into the fund. And then what the fund managers do, they say, look, every quarter, every 3 months, we're just going to pay a distribution. A distribution is where it comes from a unit trust arrangement or a pool of investments, where a dividend is generally a company that's paying out profits to its shareholders. So we can see here the fund sizes, significant differences, and as I touched on before, each fund is following an index. So what are both of these funds? Well, they are a portfolio in a box. So you've got two styles of investing. You might say, I want to invest in different Australian shares. And then I want some exposure, so I'm going to invest in some international equities. And you might have a brokerage account, and you might be buying all these different individual shares. And then I'll be buying these international shares through the brokerage account. What these funds do, they aim to be a solution where it's one investment, and we'll do Vanguard Diversified High Growth and DHHF. The fund manager will invest in the different asset classes within the one investment. So it is a one-stop shop. So you have to place one trade to get exposure to all the different underlying investments, where if you wanted to do it yourself, you might have to place several trades to get a variety of different investments. So it's as simple as that. It's a portfolio in a box. Both fund managers, they've got an objective, which is to invest in growth assets that's diversified. And let's get under the hood of both of these investments. So the composition of the Vanguard Diversified High Growth Fund, Vanguard, it's almost like a wheel within a wheel. Like it's this, both of these funds are very similar of how they invest, but basically Vanguard, they use the individual Vanguard funds. And what they do, you saw at the start, we mentioned strategic asset allocation. Now, this is the allocation here. So what Vanguard have said is that we're going to put 36% in to Australian shares, and they're doing that via their own Australian share fund. Okay, so they're getting existing funds that they've got and just wrapping them up into the one fund to give you a portfolio in the box. You can see here the international exposure, 2030, there's about 42% of international shares. And you can see that there is a portion of the Vanguard International Share Fund that is hedged. So that just smooths out any currency fluctuations. And it's a unique thing that Vanguard do with their portfolio in a box. You've also got exposure to emerging markets. And one of the big differences here with Vanguard, there is 10% allocated to defensive assets. So remember, if we draw a diagram, and if this is time here, and this is money or volatility, if you were investing in something that was 100% growth, it might do something like this. But if you were investing in 100% defensive, so our bonds and Australian fixed interest, it might do something like this. So Vanguard have 10% allocated to defensive, and they've got 90% allocated to growth. With the Vanguard portfolio, it is highly diversified across Australian equities, international equities, emerging markets, and we've got our defensive portion. So you can actually Google Vanguard VGS, and you can see that that fund has a whole heap of different characteristics. You could buy, so basically, if we go back to the portfolio in a box, you could build your own Vanguard Diversified Growth Fund. The difference is, as the funds grow and move in value, Vanguard are going to rebalance their funds. So they're always going to target a 30% or 36% Australian equity allocation, and you don't have to pay any different trading or brokerage when they rebalance that portfolio. So that's one of the big advantages of this portfolio in a box solution. It's a one-stop shop. So that's under the hood of the Vanguard Diversified High Growth Fund. They're using their existing funds that they have, wrapping it up in a box and saying, hey, come and invest with us. Let's have a look at the BetaShares DHHF, which is the Diversified All Growth ETF. The wild thing is, BetaShares, 38% of their allocation to this portfolio is in the Vanguard Total Stock Market Fund. So BetaShares are using Vanguard to get their exposure to the US equity markets. Now, this fund here, VTI, so the VTI ticker that you can see here, that's the ticker to buy this fund on the US exchange. The ticker in Australia is VTS. So if you want to Google VTS or VTI, you'll be able to see that fund and have a look all through it. There's over 3,500 US equities in that fund. It invests in the whole market. And BetaShares have clearly got the view that that's the cheapest way for their investors and their portfolio to get exposure up into the US markets. Now, what they've also done is they've used their own Australian equity fund. So there's a 34% allocation to Australian equities, and the ticker for that is A200. And of course, you can buy that fund direct on the ASX, but they've wrapped it in their portfolio. So if we have a look, the Aussie equity exposure in the Vanguard fund is 36%. In the BetaShares, it's 34%, almost 35%. So we're starting to see that these funds, the allocation is very similar. So what BetaShares have done to get exposure to the rest of the world, they've used ETFs that are from State Street, which is another global fund manager. And you can see here that they've used the ETF SPDW, which is the US ticker. And this fund invests in the rest of the world, but carves out the US ETF because they're getting the US exposure through VTI. Again, these funds, they're not really recreating the wheel or doing anything that's wildly unique. They're just using existing investments and putting a ring around them and giving you the one-stop shop, and their IP or their own technology automatically invests your money into these funds and rebalances. There's a very small, minuscule amount of currency that sits in there. I would imagine it's something to do with them buying these just in the swap. And one of the things people might ask is, well, why aren't they just buying these local to Australia? I don't know the answer. I would imagine it would be a better deal at a wholesale rate to buy them direct in through the US, because they're a big fund manager and they do things with scale to keep the costs down. So investment time horizons. Let's just look again to see where these may fit. So if this is time, and we might go 2 years, 5 years, 7+ years, and we might do dollars or expected return. We know if you had cash, if this is cash, cash might just do that because it's low risk, right? Property might do this because it's higher risk, it's a growth asset. Shares, because they're priced daily, they might do this. But we need to know that with these diversified funds, because the underlying assets are equities, Australian equities, international equities, we're wanting to hold these funds for at least 7 years. Because if markets drop, if coronavirus outbreak happens again and markets go crazy, we want to make sure that we don't need to sell assets at the worst time. And I'll show you a diagram shortly. So I believe it's going to be a 7+ year hold for these investments because they are a very high risk fund. The Vanguard Diversified Growth Fund, it is a 90% growth allocation and 10% defensive. So like I said before, 10% in fixed interest and low volatile assets. Whereas the BetaShares Diversified All Growth Fund, it is 100% growth. So it is even more high risk. Is it high returns? Let's have a look. So where do they sit in the volatile markets? So here is the COVID pandemic, right? So this diagram here, this is a total return. It's not the share price. It is the total return since the end of 2019. Because remember, the fund that BetaShares has on offer at the time of recording isn't 12 months old yet. So we don't have that much data on it, but we can see that in a choppy market, we did take a hit of our capital. But as you can see, both of the funds are basically doing the same thing. The blue one is Vanguard and the green one is BetaShares. And you can see they just track very similar leading up to the COVID crunch or the COVID peak, basically identical return. However, a 12-month return doesn't mean that much when we need to hold these assets for more than 7 years. We don't have data on the BetaShares fund because it hasn't been around for 10 years, but we know that the underlying funds and the underlying investments have a long track record because it's an index fund. So is this a good indication of what the BetaShares fund may do in the future? Who knows? But it's just interesting to understand what the total returns have been like, just so you can see how the funds work over the last 12 months. So over the last 12 months, and again, grain of salt stuff, we don't really care about the last 12 months. There's been basically a 1% difference with the BetaShares fund clipping Vanguard by about 1%. Over the 3-year period, Vanguard was 13%, but over the 10-year period, Vanguard did about 12%. And that is after fees before taxes. So long track record, and I've used the managed fund for the 10 years. Would we see, 12% here? Not sure. We'll check back here in 10 years. But it's just interesting to see that Vanguard, it's a high growth fund, 90% growth, over the last 10 years has produced 12% per year in return, which is a lot more than cash, right? But we know with risk and return, we're putting capital at risk, so we would expect a higher return than just cash. Let's have a look at the fees. 0.27 with Vanguard and 0.19 with BetaShares. Look, if we had $5,000 invested, it's $4 per year more expensive with Vanguard than BetaShares. Now, this is a very interesting space. Fees, they are so important. We want to pay low fees or as low fees as possible when investing because it can have an impact on returns. Has Vanguard only really had the main one-stop shop in Australia for the last handful of years? Probably. Will we see their ETF fees come down as new entrants like BetaShares come into the market? Maybe. It's competition. We know market forces come into play. So the question is, if the returns are pretty similar and it is cheaper to invest, and we'll just say over the last 12 months with BetaShares, is the extra 1% return worth the $4 fee saving to you? Only you can answer that. It's a high risk fund. You've taken on more risk and you've got a slightly higher return, but these are the things you got to think about. Or do I want to pay a little bit less and have a little bit more of a conservative portfolio, but have a slightly smaller return? So these are the things as an investor where I just want to show you under the hood so you can make your own decision. Okay, so coming up, we're going to talk about the benefits of diversified funds and the limitation of diversified funds. But before we do that, I want to talk to you about Glen's online investing school. If you are interested in having a bit more of a deep dive around investing, there'll be a link below. Make sure you check that out. It's low cost. There's hours of education in there. And also, if you haven't already, I've got a book called Sort Your Money Out and Get Invested, where it is over 100,000 words, 400 pages of personal finance, investing. I go deep. So if you want those resources, you can check them out in the comments below. And while you're there, why don't you smash that like button? And if you like what we're doing here, hit the follow, hit the subscribe, whatever you press these days. And I thank you for your input. Now, the diversified fund benefits, they're relatively low cost. So we know if I invest in direct shares, there is no ongoing management fee, but I've got to do my own rebalancing. I've got to do my own record keeping. They're a portfolio in a box. They're set and forget. All you need to focus on is pumping money into these portfolios because they will do what's on the box. Each of these portfolios, they're products. You can go to the Vanguard website. You can go to the BetaShares website and download the product disclosure statement. They are a product. So they're portfolio in a box, and they're just a great go-to if you are just getting started with your research, just to understand these style of investments. The asset allocation is sorted. So as an investor, you don't have to worry about, well, what percentage do I want in Australia? What percentage do I want in international equities? What percentage do I want in the US or emerging markets? The fund manager takes care of that for you. The rebalancing is included. So if you have a big run on Australian equities, what happens with the rebalancing? They'll take that profit and put it into the other investments, so it is rebalanced, as I touched on before. All that happens automatically for your fee. They really enable you to learn about market fluctuations and the impact it has on an overall portfolio. And I just want to touch on the key differences with the Vanguard fund is that you can get it as a managed fund or ETF, which, if you are wanting the Vanguard one, and we did a video on the Vanguard Personal Investor, it may be a lower cost to buy the managed fund version via the Vanguard platform. They've got a very long track record as a fund manager. 40 years at managing funds. It's not their first rodeo. They'll basically do what's on the box. So they do have that long-term track record as a company. We know that past performance isn't an indication of future performance and all that crap, but they've certainly got that long track record. And one of the key differences with the Vanguard fund is that there is a 10% allocation to defensive. So it's a 90-10 fund where the BetaShares fund is 100% growth. So a little bit higher risk, but again, what do you want in your portfolio? We know that with rebalancing and defensive assets, most of the time, a 90-10 portfolio will outdo a 100% growth portfolio, because what happens is as the growth assets grow and they rebalance, they put that profit into the defensive assets and lock in that capital. So if there is a negative market event, with your compounding positive returns, the compounding negative returns are less because there's less time to recover because they've had some money in defensive assets. So what are the limitations of these diversified funds? They could be considered expensive. So if you just wanted to invest in a couple of ETFs yourself, it could be considered expensive to have a portfolio in a box. They might not be appropriate if you're getting older and you are in what we call pension phase, or you want to draw down an income, because they're not, the main focus of these portfolios is growth, not dividend yield. So there could be limitations, but they could be seen that they're great for accumulation stage. There's limited ethical screening. So these funds just follow an index because they are index funds. So if you wanted to invest in things that were aligning with your values as an ethical investor, these funds might not be for you. You might have to search other places for an index that just tracks ethical companies all around the world. So this could be seen as a limitation to these funds because they just splash all the money, US market, you get what you get. It's an index, right? And again, if you do want a bit of sex and violence and a fund manager with high conviction and they're doing the trading and they can outperform the index and all that stuff, well, an index fund isn't for you anyway, okay? They might work, and I'll just show you where they fit, and then we'll talk about where they might work as well. So we've got DIY shares, and we know that the cost is quite low for them. You can build your own portfolio of ETFs, and as you can see, as we get up here, there's more features because the two funds sit in a diversified portfolio. They're easier to manage. There's more features, rebalancing and all that stuff, and they take care of the asset allocation, but there is a higher cost. So it's horses for courses. And as an investor, once we understand how this stuff works, it's easier to make your own decision. Now, what some people have done is they may use these funds, either or, as a core or satellite approach. So someone might have, and we'll just call this 100% of your money, you might put 80% of your money in one of the diversified funds here, and then sprinkle the balance of your 20% of your portfolio into individual stocks. You might want to invest in a thematic ETF, one that just invests in tech in Asia, or hydrogen companies around the world, or battery tech. So they are a good core as a beginner point. So with investing, remember, it's not all or nothing. You may go, okay, I'm going to use one of these diversified funds as my core, and then I'm going to invest with satellite funds around that. So that's certainly an option as well. So what do you think? I'd love to know in the comments what fund you use, if you use one of these funds, or what fund you're leaning towards. If you are looking at these two diversified options. Now, the Vanguard Diversified High Growth Fund, it's very popular because it really was the only one-stop shop available in Australia for many years. And that's why competition's good, because it brings other entrants into the market. So I'm really interested to see, do you prefer a lower fee with 100% growth and a slightly higher percent return? Or would you rather an allocation to defensive assets, an allocation to some hedging? And we didn't really get into hedging, but Vanguard certainly believe that they want a portion of their US equities hedged to counteract the impact of currency when we're investing in different currencies. So we've really got two offerings here. The underlying asset allocation for both is pretty similar, if not almost identical, but it's really horses for courses. I'd love to know what you think, and good luck on your investing journey. You're more than welcome to join the My Millennial Money Facebook group to continue this discussion. Thank you so much for watching. I'll see you soon.